Hi friends, welcome to Adda 24/7. Welcome to the mini marathon on module A and B combined. Share this channel with your friends. Like the channel, subscribe to the channel, click on the bell icon. Okay, do this fast. Forgotten that. Okay, so that's why we'll do it again. And this is asked in your CAIIB also. Mind it. So let's do this. First, what do you want? You want GBP to INR rate. Okay, you want GBP to INR. Do you have it? GBP to INR? You don't have. What do you have? USD to INR, you have it? Yes. GBP to USD, you have it? Yes. So use the chain rule then. GBP to rupee equals to, look at this, GBP to INR equals to GBP to dollar into dollar to rupee, isn't it? Now both the rates you are having it, GBP to dollar, this one. You want what? TT selling. Selling means right side. Kindly note here. Few things I'll give you at the outset only. Whenever you solve any Forex problem, kindly focus on 1 to 3. Whether it's buy or sell, then the forward points and TT margin. Never forget any of these steps, never forget. And follow the sequence also. Same sequence, don't interchange the sequence. So now it is selling, so sell. Forward point 0. Why? Because it is a TT transaction. Telegraphic means 0. Forward points are always there in bill rate. TT given 0.15. So now solve this. GBP to dollar is 1.9349, right side, selling, into USD INR 43.87, selling. Right side is selling, left side is buying. Okay. So solve this 1.9349 into 43.87. You'll get it as 88.88. So is this your final answer? See here, 1 is done, 2 is done, but what about 3? TT margin remaining, isn't it? So 88.88 into 0.15%. So 0.15 upon 100. Solve this. You'll get it as 0.127. Are you getting this? Here. It may happen, I may go wrong. Huh? Kindly check this. If it is 0.0127 or 0.127, because many times we do mistakes. Okay. So let me check 88. You also check it. 0.88 into 0.0015, right? 88.88 into 0.0015. Yeah, I'm getting this as 0.13. Okay, 0.13. Are you getting this? 0.13? 0.13 I'm getting. So that's okay. 0.1312 is okay. Even if you get this as 0.13, you can do it the same way. So it is 89.01. So roughly 89. Okay. So now you can take this 0.3. 0.13 also you can take it. Now what have you to do? Look at this. Whenever you are dealing with TT margin and selling, whenever you are dealing with selling, you have to add the TT margin. So here I'll add this now. 88.88 plus 0.12 or 13, whatever it is. It is 89.01 or 89. Okay. So forget it. Take it round 89. Okay. So this is your rate, final rate. Got it? Second one. Spot rate is given as 35.6065. Forward for 1 month is given as 35.30. 2 month 55.50. 3 month 85.80. Transit period 20 days. Exchange margin 0.15%. Find the bill buying rate. Kindly note. Buying means left side. Again, don't forget the basics. 3 buy or sell. Forward margin TT. Here forward margin will come because you are dealing with the forward rate. Let's all see this. Again the same. 3 steps: buy or sell, forward margin, exchange margin. Don't miss this. Okay. So first is buy or sell. So buy. It's given. Bill buying rate. Okay. Forward margin. Yes. Forward margin will come over here. Why? Because we are dealing with 20 days. Transit period is 20 days. What do you mean by this? Look at this. Transit period means what? The period for which you are, when you send the documents from this negotiating bank over here to the issuing bank, the time required to reach there, check it and pay. All these things included. So what is given? Transit period is 20 days. So spot is 35.6. See this 35.6. 20 days from here. So it will come over here between. See here, 20 days will lie between what? 0 to 30, isn't it? It will lie between 0 days and 30 days. So only 1 month is of use to you. 2 months, 3 months are of zero use. Okay. So 2 months and 3 months out. Only 1 month is of use. So spot is 35.6 and 1 month is, what is the rate given? 35.30. So it is a discount. Currency is in discount. Okay. So discount means subtraction. See this. Spot minus discount. See this. Spot minus D. So what is the discount? Bill buying. So 35. So take 35 over here. So 35.6 minus 35 means 0.35. So it is 35.25. So which is the rate you will be taking now? See here, you have to apply the buy low, sell high maximum. Buy low means what? Whenever you have a rate in between, whenever you have to do a transaction in between and you don't know the exact rate for that day, you have to take the lowest rate of while buying of first one and the last part, means the first end and the last end. So here the first end is spot, last end is this 30, right? So 35.6 and 35.25. You have to do buy. So buy means buy low. Buy low. So which is the low? 35.25. So now what have you done? Buy and sell done. So it is buy. Forward margin done. You have calculated this forward margin and then you have got this 35.25. What about the TT margin or exchange margin? 0.15%. So multiply this 0.15%. 35.25. Now take this rate. 35.25. Forget this 60 now. So 35.25 into 0.15 upon 100. Solve this. You should get this as 0.0528. This is your TT margin. What is the rule? Just now I told you in the first problem. Selling we add, buying we subtract. Here we are buying. So subtract. So do it. 35.25 minus 0.0528. So it is 35.1971. This 35.1971. You are getting this? Okay. Important case studies here. These case studies you'll see in the exam as they are. Okay. Some numbers might be here and there. Before going ahead, everyone subscribe to Officers Adda 24/7 English channel as well as bilingual. Click on the bell icon. Share. Join the crash course first because exams are near. Okay, they have just started. Full crash course, full details are covered. Some numericals like these are covered. Join it. Join the Mahapack. Right now you're getting 81% discount. 81, huge. I'll show you how. Okay, at the end. Let's carry on with the questions. Let's go for some theory questions now. Which section of FEMA means Foreign Exchange Management Act 1999 defines foreign exchange? So which section defines foreign exchange? Section 1, 2, 3 or 4? Which section of FEMA defines? Let me see the answer from your side first, then I'll answer. Okay? Give me the answer, everyone. So FEMA section 2, that is the right answer. Section 2 defines the foreign exchange. Okay? So FEMA section 2 defines the foreign exchange. Means what is the definition then? Foreign exchange means foreign currency and includes, understand this, foreign currency, it means foreign currency and it includes what? All deposits, credits, balances payable in the foreign currency or any draft, traveler's checks, letter of credit, bills of exchanges expressed or drawn in Indian currency and payable in foreign currency. Understand this. Drawn in Indian currency and payable in foreign currency. Even that is considered as foreign exchange. Any instrument payable at the option of the drawee or the holder thereof any other party. That is also foreign exchange. Means here payable at the option of the drawee. Drawee means who is the drawee? Drawee means on whom the bill of exchange is drawn. In your check, your bank is the drawee. Okay, bank is the drawee. Okay, the person to whom you are giving the money is a payee. Okay, So any person where the description is of that drawing, that is also foreign exchange. Okay, part thereof. So just broadly speaking, it is what? Foreign exchange is all claims payable abroad, whether consisting funds held in the foreign currency with the banks abroad or bills or checks payable abroad. Right? Means anything, any currency which is payable abroad is known as foreign exchange. Now it is not only exchange, it is all the bills also. It includes the bills also. Got it? So that is the meaning of this. Quite interesting. Okay, let's move on. Second one. Dash is the current exchange rate at which the currency pair can be bought or sold. So day rates, fixed rates, spot rates or combined rates. See here, current exchange rate at which currency pair can be bought or sold. Currency pair means what? Dollar to rupee. Dollar to rupee. That is the currency pair. Okay. So currency pair means two currencies. So at which they can be bought or sold. So what is it? Dash is the rate right now. So what is it called as? Is it called as day rate? Is it called as forex rate, fixed rate, or what is this? Spot rate or combined rate or any other rate which you want? Type in the comment section. Which rate do you think? Which is this rate? Think over it. Let me see the answer from your side. Everyone, yes, think over it. What is this rate called as? Day, fixed, spot, combined? What? Yeah, it is. Comment section, comment section. Let me see the comment section. Everyone fast in the comment section. Everyone fast. Okay, the answer is spot rates. Okay, these are called as spot rates. Okay. See here, the forex spot rate is a current exchange rate. Okay, at which the currency pair can be bought and sold. Means what is the? I'm having dollars, you are having rupees. So we'll decide on the rate. It's a normal business. That's called as a spot rate. What is the meaning of spot? Spot means T plus 2. Suppose if I do the transaction today, the settlement should be done in 2 days. Okay. Due to the vastness of the market operating in different time zones, most of the forex deals are done on spot basis. Okay, most of them, because spot means what? That much you can take the risk, 2 days. Meaning thereby the delivery of the funds placed means funds is done on the second day. Okay, second working day. Remember, working day is important. Okay, the rate at which such deals are done is known as spot rate. Okay, in which 2 working days are used. Suppose if I use the same day, then okay, let me get back to the basics. So same day, it is known as cash. Cash, or we call it ready. Cash or ready. That is on the same day. T. Okay, T we call it. Suppose if I am doing the dealing tomorrow, settlement tomorrow. Tomorrow. So it is called as Tom. Okay, Tom means what? Next working day. Remember, it is on the T plus 1. Okay, T plus 1. So it is T plus 1. Working day. Huh? Suppose if I am doing it on T plus 2, then it's called as spot. Spot. Right? T plus 2. Right? After spot, it is called as forward. Forward. So this is greater than T plus 2. Anything it can be then. It can be 1 month, 2 month, 3 month, 1 year, 10 year, 100 years. It can be anything. Okay. So got it? Got this point? So spot rates are base rates for the FX rate. These are the base rates. Okay. The date of delivery of the funds on the date on which the currency actually takes place is known as the settlement date or value date. Okay. Bank withdraws the facility of low interest rate by delinking the bills by converting commercial rates of interest if. What do you mean by this? Facility of low interest rate by delinking, okay, the bills by converting them to commercial rate of interest means what? See here, this is known as, this concept is it given over here? No, it's known as crystallization. Crystallization. Crystal. Okay. Crystallization. So this method is known as, what do we do in crystallizations here? Suppose if I given you a dollar loan of let's say $50,000. Okay, if I give you the loan of $50,000, and if you don't pay on time, so what do? I convert this dollar loan to rupee loan, whatever that rate is. Okay, on that spot rate, whatever it is, I'll convert it. Okay, at TT selling rate. Remember, it's always TT selling rate, selling. So I'll convert it at TT selling rate, and whatever that amount is, so that is in rupees now. So this is the question asked. Bank withdraws the facility of low interest rate by delinking the bills by converting the commercial to commercial interest rate. Interest, it is to commercial interest rate, right? If export bills are not realized within 30 days of maturity, export bills are not realized within 60 days of maturity, export bills are not realized within 90 days of maturity, export bills are not realized within 120 days of maturity. So what is the answer for this? So the answer is A. As per your books, it is A. But now RBI has given a special permission also. Banks can crystallize their loans whenever they required. Whenever they require means it's as per the discretion or the arrangement between the customer and the bank. Okay, that's what there's a special permission given by RBI. But as per your books, it is export bills are not realized even after 30 days of maturity. Bank is expected to receive the amount of such export, whatever funds we have given. Okay. So if we have whatever funds we have given or whatever loan we have given from the overseas buyer on the due date agreed upon between the buyer and the seller. So it should come on the due date actually. Okay. But however, if the export bill is not realized even after 30 days of its maturity. Now look at this. The thing which I gave you, RBI gave this special permission, that is for side bills. That is not for these maturity bills or due date bills. Okay, usance bills. However, if the export bills are not realized with even after 30 days of its maturity, bank withdraws the facility of low interest rate. Okay, by delinking the bills and converting them to commercial rate of interest. This is called as crystallization. Okay, so what is crystallization? It means that converting the dollar loan into rupee loan because the customer is not paying it. Okay, so the answer for this is 30 days. 30. Okay, next one. RBI has issued internal control guidelines for foreign exchange business. Under ICG, which of the following limit is not required by the banks for the Forex operation? So, not required. Overnight limit, daylight limit, exchange limit, and gap limit. Which is not required? Overnight, daylight, exchange, and gap limit. First, I'll explain you what is this. Okay, what is overnight limit? Overnight limit means maximum amount of open position which I can keep at the EOD of the day, end of the day. Okay, means closing cash. See here, I'll give you simple example. Closing cash which is kept in the vault, that is overnight limit. Okay, similarly we have closing currency, this limit for the Forex also. Overnight limit means closing at the EOD. Daylight means what? I'll give you a simple example. Teller cash. Vault cash and teller cash is different. Teller cash means what? What cash can the teller bring on the counter from that vault? That is teller cash. Same thing over here. Maximum amount of open position or exposure the bank can expose itself during the daytime, during the working time. That's known as a daylight limit. Gap limit. Maximum interim period month exposure which bank can keep is called as gap limit. Means interim period or exposure, period or month which the bank can keep. Means suppose if I am having the open position. What is open positions here? There are two types of open positions. Always remember. One is long, second is short. Long and short. Okay, these are the open positions. So if my total buying, number of contracts buying is greater than number of contracts selling, then it's called as open position, long. And if my selling is more than my buying, then it's called as short position. Okay. So whenever I am having long position, I'll need to buy the derivatives. In both the cases, I need to buy the derivatives to hedge the risk. Okay. So this derivative I'll be buying put if I am having a long position, and reverse one is call if I am having the short position. Okay. So this gap limit is maximum time. How much time can I keep this open position? Long or short? Anything. Maximum week, month, period, whatever it is. Counterparty limit. So counterparty limit, what is here? It's not given over here, but let me explain you. Maximum amount the bank can expose itself to a particular country or party. Maximum amount means how much can we expose ourselves to some, let's say, some single party in the foreign country. Country risk means same, that of the single country. Whatever, like country risk means basically what is the level of that country, rating of that country. Okay. So that is, these were the few terms which I needed to explain. Okay. Next one. A documentary credit or LC can be defined as a signed or authenticated instrument issued by stock market, RBI, FEDI, buyer's bank. So who does issue it? Stock market, RBI, FEDI and buyer's bank. Who issues the LC? This is quite simple. This is a JIB question. Yeah. Who issues it? Correct. It is issued by buyer's bank. This is also called as issuing bank. Issuing, right? Issuing bank. Issuing bank. Okay. So this is also called as issuing bank. Got it? Now let me give you some definitions, important ones. Okay. Buyer's bank means it's issuing bank which issues the LC on the request of the buyer. That is very important. Okay. Request of the buyer, because after all buyer is requesting you or importer is requesting you. And what does this LC contain? LC is known as bank to bank LC. Okay, it means it is issued by the bank and it is promised to some bank, that bank of that seller, right? So it is a signed document issued by the buyer's bank or the issuing bank, embodying certain an undertaking to pay upon presentation of certain documents mentioned in that LC. Okay, and which conforms to the terms and conditions of the LC as well as that of UCP and ISBP. Okay, so that is basically the meaning of LC. There are various banks in this LC. Okay, this is known as issuing bank. Then there can be various banks. There can be advising bank. See here, advising bank. Advising. Then there can be negotiating bank. Negotiating. There can be confirming bank. Confirming. Okay, confirming. There can be just a forwarding bank. Even that bank is allowed. Forwarding bank. Just forwarding. Then there can be reimbursing bank. Reimbursing. Okay, so these are all the types of banks. And there's one more, nominated. Reimbursing. Nominated bank is one more. Nominated. Okay, so these are the various banks in the LCs. So we have separate definitions for them. We'll cover them as and when they come. Okay, so let's move on right now. Which type of LC is available for transfer in full or in part in favor of any party other than the beneficiary by the advising bank at the request of the issuing bank? So what is that LC called as? Which is available for transfer to any party. What do you mean by this concept? Say this. What is LC? LC is issued by the buyer, okay, buyer to the seller, right? Means it is issued by the issuing bank. Issuing bank, okay, on the behalf of the buyer. Buyer requests to the issuing bank sends it to the advising bank, okay, and this advising bank gives it to the seller, okay, and then seller manufactures the goods and sends it to the buyer. Now the real question is, if your seller is an agent, that seller is not the actual manufacturer. So what will this guy do? The LC which it has received, it will transfer it to sub manufacturing, let's say A and B. Okay. So such LC where our seller is an agent is known as irrevocable, revocable, irrevocable, confirmed and transferable. So it is known as transferable. Okay. Where the LC is transferred to some other manufacturers. Okay. So transferable credit is available in full or part. Remember, full or part means I can transfer the full amount to only A. I can transfer the part amount to A, part amount to B, part amount to C, D, 1000 guys I can transfer. Okay. In favor of any party other than the beneficiary. By the advising bank. See this, it is done by the advising bank at the request of the issuing bank. Okay, issuing bank requested that kindly transfer this LC, and also at the request of the first beneficiary, means your seller. Seller should give you in writing that, see, kindly transfer this LC. I am the agent, kindly transfer it to so and so. There are certain rules and regulations for them regarding the amount, regarding the name of the buyer, everything can be changed. There can be more than one second beneficiaries, okay? Means I can transfer it to A, B, C, D, E, F, anything. But this second beneficiary cannot transfer it further, means A cannot transfer it to someone else. Only I can the first level transfer is allowed. First level means this level. Only this is allowed. This is allowed. But A transferring something to C, not allowed. Okay? So only first level transfer is allowed. So second beneficiary cannot transfer it further. Got it? So yeah, that is basically this regarding this LC. Got it? Clear everyone? This concept should be very clear to you. Okay? Next one. Under the UCP 600, time allowed to the banks to document for document review is 5 banking days, 7 banking days, 10 banking days, and 14 banking days. What is the time allowed? Time allowed to the banks is, it is 5 banking days. Okay, 5. UCP 600 talks of 5 banking days. Banking days, remember, banking. Whenever you are working, okay? Banking means regularly working. Regularly working means what? Suppose if I come on 1st April for work, so I am not working. Okay? If I'm 1st April means it's not for customers. Where the bank is regularly open for customers, that's called as a banking day. If you do your private work, personal work, or some other work of the bank which is not related to the customer hours, that is not a working. Okay? Banking day, that's not a banking day. So banks had a reasonable time. See, UCP 500 was there. It said 7 days. Now it has shifted to 5 days in UCP 600. That is also long back. So you only remember 5 days now. Okay. Got it? Which of the components of the bank's balance sheet is not included in the liabilities? Not included. Okay. Inter-office arrangements, adjustments, provision of income tax, overdrafts, and capital. So not included in the liability. Which of them is not included? Remember this question, not. You have to always focus on what is and what is not. Whether you want the true answer or whether you want the wrong answer. So the answer is, everyone. Let me first cover some details. Not included in liabilities. So what are liabilities basically for any company or any bank? You can say liabilities means which we have to pay. Okay. Inter-office adjustments. So these are what basically inter-office adjustments means within the branches some adjustments. So it can be over there or within the banks also any adjustment. Provision for income tax. So liability means I have to pay. So this I have to pay, right? Overdraft. Now what is overdraft? This is something important. What is overdraft? Overdraft is a loan. It's a bank product. Okay. So how can it be included in the liabilities? Overdraft is a loan. What are loans in the banking system? Type in the comment section. What are loans in the banking system? Are they liabilities or assets? Right? So ODs are repayable on demand, though there may be specific due date also. They are shown on the asset side of the bank's balance sheet. These are the assets. Okay. So these are not liabilities. Remaining things, this capital, inter-office, and all these are provisions. That is, these are all liabilities. So the basic answer over here is, it is OD. Okay, it's an asset. Which of the following is not one of the Basel framework's way of calculating credit risk? Not. Okay, not. So you want false. Remember. Okay. Value at risk approach, standardized approach, foundation internal rating based approach, and advanced internal rating based approach. Not one of the Basel frameworks way of calculating credit risk. We are focusing on credit risk over here. So what is the answer? So before giving the answer, again I'll give you the explanation first. Basel framework we are talking of. So Basel 2 or Basel 3, anything, both of them. They are basically, it gives banks ways to assess the capital needs. Okay, capital needs based on the credit risk. Credit risk, not only credit risk, it's credit, market and ops risk. All the three risks are included in this Basel 3, right? So our question over here is for credit risk only. Now the two approaches for credit risk are basically standardized and IRB. Standardized and IRB. Then you'll say IRB. Yeah, IRB means internal rating based. Now this IRB is further divided into two parts, FIRB and AIRB. So this credit risk basically will be dealing in what? This is credit. This is for measuring the credit risk. This is for measuring the credit risk, and this is for measuring the credit risk. So what is this for then? Value at risk. This is the real answer, not the way. But what is this for? This is for measuring the market risk. Remember, market. Okay. All these three approaches, standardized or FIRB or AIRB. Okay, these three. So under this standardized approach, look at this. What do? The rating is given by the external agencies. Okay, based on the ratings of the external agencies. So bank will depend on those external agencies' ratings. In FIRB approach, what happens? Under FIRB approach, the ratings will be given by the bank. Okay, but the fundamentals of that, or the parameters of that, or the feed for that will be provided by RBI under FIRB. What about by AIRB? Under AIRB, all the things will be decided by the bank, and that is the ideal way. That is the ideal way. Okay. So banks model this under this FIRB, basically banks model only probability of default, while in AIRB they can calculate loss given default, exposure at default, means basically everything. Why? Because the parameters are given by the bank only under AIRB. Okay. So the answer is VAR, value at risk approach. Which of the following is not one of the Basel 2 framework's techniques for calculating the operations risks? Now this you can consider Basel 2 and 3 also. 3 also no change in this. Also only one word, enhance risk. Basic indicator approach, standardized approach, advanced measurement approach, and FIRB, foundation internal rating based approach. Just now we saw it, right? What did we say about this credit risk? Credit risk was FIRB also, right? So if this FIRB is for credit, is it used for operations also? So not the one is not. Look at. So the answer is D, FIRB, that is for credit. Okay. All these three are for ops. Okay, ops risk. Now let me give you some idea about this. Okay. These are the three basic methods: basic indicator, standardized, and AMA. Okay. Under basically this BI, basic indicator approach, we have a alpha factor. That alpha factor is always taken as 15%. Okay. And we take average gross profit under basic indicator. Average gross profit for 3 years. Okay. So that is basically this basic indicator. Whereas in standardized, we have 3 percentages. What are the 3 percentages? They are 12, 15, and 18. Banks are divided into various categories. Categories means various segments. It can be retail banking, it can be retail brokerage, it can be this commercial banking, it can be corporate banking, agency services, all these, and these are given various ratings. Retail comes under 12%, corporate comes under 18%. Okay. And this commercial banks, this agency service comes under 15%. So these are all the percentages under the standardized approach. And under AMA approach, see this, AMA means what? It's again related to the bank, completely done by the bank. So under AMA approach, banks can create their own models to quantify this credit risk, operations risk. Okay, It uses four quantitative elements. Which are those? Internal loss data, external data, scenario, and business environment analysis. So these are the four parameters used under AMA. And internal control factors for the methodologies such as internal measurement approach, IMA, and loss distribution. So these all methods are used under AMA. Okay. So for operations risk, remember there are three methods. Got it? Okay. Next one. Which of the following is an important factor for limited hedging of operational risk? Limited hedging. What do you mean by limited hedging? Controlled hedging. Limited means controlled. Controlled. Okay. Limited to a certain limit. Absence of commercial vendor to sell operations risk data. Operational risk process correlations are fixed and known to the buyers and sellers. Operational risk assessment is objective and rigid. Identifying operational risk accurately that are not yet apparent in the competitive task. So which of them is used as a limited hedging? Okay, limited hedging. Let's look at it. So the answer is, okay, before coming to this answer, let me give you the first some explanations about it. Then we'll come to the answer. Hedging means what? Controlling the risk. Controlling. Okay. Suppose if I buy some bond, and in that bond what happens? Let's say I buy that bond for rupees 100. Now if this price of the bond goes down to 90 or 80, I'll be in a loss. So how to control this loss? To control this loss, I buy the derivatives. Remember, derivatives position is always opposite of that of the commodity. Means if I buy the bond for 100, it's called as a long position. So to counter this and to prevent the risk, I'll buy the reverse position in the derivatives market. I'll buy the put option. Okay. So measuring of and recognizing of this operational risk is subjective. Subjective means each bank does it differently. In part because the possible loss has yet to occur. We are measuring it. What do we measure? We measure something which can happen in future. That's the proactive approach in the banking. Okay. So various operational risk models have been created for this own subjectivity, you can call it, or own methods, you can call it. There can be correlation method. Okay. Correlation means we compare two elements. Okay. Then this correlation method is generally adopted. It is a common method. Why? Because that is easy for using. Okay. There can be other methods also. Total data validation methods. Various are there. So rather than known and basically correlation is a fixed one. But what is the answer to this is then means which one is an important factor? So it is basically this. Okay. This one is an important factor. Why? Because identifying operational risk accurately that are not yet apparent is a competitive task. Okay. Because this is very important. What is this? What are remaining these? Absence of commercial vendor to sell. These are known to all, isn't it? Operational risk process correlations are fixed and known to the buyers and sellers. So this is known to everyone. Operational risk assessment is objective and rigid. But this part, not yet apparent, is a competitive risk. So whatever is not seen, judging that is really the critical factor, right? Which of the following statements regarding the treasury are true? So you want the true one now. Okay, true. Statement 1. Treasury operates in interbank markets which are free of credit risk. So these are free of credit risk. Statement 2. Treasury is highly leveraged at risk capital allocated is as the risk capital allocated is just 2 to 5% of the transaction size. And statement 3. Operational cost of treasury is high. Which of them is true you want? Okay, which of them is true? So what do you think should be the true one over here? See, the options are given as 1 and 2, 2 and 3, 1 and 3 and 1, 2 and 3, all of them. So the answer is, you want the true one, huh? Many of us have the habit of typing 1, 2 and 3, all of them. But that is not the answer, because frankly, very clear, operational cost of treasury is very low, it's not high. So this is false. So that is done. Okay. So 3 is not the answer. So 3 is not the answer. Do you have some single option then? Only 1, only 2? No. So you have only one option which is without 3. That is A then. So A will be the answer. So now let's check whether A is true. Look at the options. Treasury operates in interbank markets which are free of credit risk. So there is no credit risk in treasury. That's a true option. Why? Because treasury always operates in, it tries to nullify the credit risk first. The remaining risk will always be there, operational and market risk. Okay. So it mostly operates in the interbank markets. Interbank means buying from one bank, selling to another bank. Okay. So second thing is highly leveraged. So that is also true. Highly leveraged. Because why highly leveraged? Because as the capital allocated is just 2 to 5% of the transaction size, means suppose if I give treasury rupees 100, that treasury can make out of that 100 roughly 10,000 rupees. It's so much leveraged. Okay. So this is a basic point, because only the smaller amount is provided to treasury, and that's why what happens, all the banks are nowadays focusing on treasury operations, because that is the lowest cost business, lowest cost. Okay. So that's why all want this treasury business only. Got it? So done the answer. Next one. Treasury in foreign exchange product may enter into a spot trade where the settlements of funds is done on dash day. Now this is what spot trade you are talking of. First day, second day, third day and fourth day. Under spot, when is it done? Okay, let's carry on the basics again. Cash ready, right? This you had studied it in your JIB also and here also. Cash ready is done on the same day, right? First day only. You call it first day. First day means same day. First equals to same. Okay. Second is Tom. Tom is always done on the second working day. Next working day, not second day. It is called as second day. Second day. Or you can call it as a next working day. Next working. Remember, whenever we say second day, it is not calendar day. Huh? Next working day. Then this spot is basically spot. That is basically third day, or that is equal to the next to next working day, second working day. Okay, second working day. Understand the difference, huh? Second working day, and after the spot. So after spot is this forward. Any day after spot. Okay, any day after spot. Okay, after spot. Got it? So any day after spot is forward. Got it, everyone? So this is the basic classification of, so here what is the answer then? It is third day, right? Spot is third day. Got it? Next, treasury can be invested in, number 1, interbank operations. Number 2, short-term instruments like gilts, and statement 3, nostro account. Where can treasury invest? 1 and 2, 2 and 3, 1, 2 and 3, and cannot be invested. Treasury can't invest anything. Now again, many of you are doubting whether 1, 2 and 3 is correct, because in the earlier statement I had said, one question I told you that we are in the habit of typing all of the above. That's why the answer was not all of the above. So everyone is now afraid. But the answer is C, 1, 2 and 3. Treasury can invest in these 3 elements: interbank, short-term instruments and nostro. Now do you mean to say that only these 3? No, that is not the answer. The options given here are 3. So these 3 are the answer. There can be others also, because Treasury also has the proprietary book. Okay, proprietary book means basically it is for earning profits. Okay, so Treasury can invest in all of these. Okay, 1, 2 and 3. It can further invest in Forex also. Is it given over here? No. Okay, foreign exchange surpluses made by the Treasury can be invested in this interbank loans for maximum 1 year. Interbank loans are generally for 1 year. Okay, mostly these are overnight. Overnight means we call it call, right? Call, notice and term. Short term investments it can make. Short term investments means like these gilts, which are safe. Gilt means what? Government fund, government bonds. These are G is for government over there. Okay, also it can invest in some triple rated bonds. Triple rated means good bonds. Okay, nostro accounts it can also keep the funds. The nostro floating funds are always kept in the nostro many times. Okay, pending utilization. Now this nostro, keeping it in nostro is very difficult. I'll tell you why. Because they don't give you any interest. Nostro is a current account, so that's why they don't give you any interest. So that's why this keeping in nostro is the last option available. Okay, right? So the answer is 1, 2 and 3. As I told you, I'll be showing you at the end how to join the Adda 24/7 crash course. Here, go to Adda 24/7. Join it immediately, because it has just now started. Go to Adda 24/7. Go through the app. In the app, you get 1% extra. Click on JIB and CAIIB. Okay, JIB and CAIIB. Look at this. Click on CAIIB November. Crash course. Join this crash course. Look at the discounts. I'll show you. Put the code Y432. See this. Y432. 80% plus 1% extra, 81%. And what are you getting in this? What are you getting? Ebooks, test series, online live classes, recorded sessions, everything you are getting. You can join the Mahapack also. In Mahapack you are getting double validity right now. 15 plus batches per subject in Mahapack. Per subject. Plus ebooks, test series, those are obviously there. Here you are getting 6 plus 6 months. Means you buy for 6 months, you get it for 12 months. You buy for 12, you get it for 24. Don't forget the code Y432. See here, this code is very important. This gives you the highest discount. Y432. Look at this, 80% discount plus 1% using the app plus double validity. Right? So what are you waiting for? Join immediately.